From the morning reading, financials lead the broad market rebound following the FOMC pullback on Wednesday. Bull flags bounce. Breadth weakened compared to the prior session as decliners led 1712 to 1333 on the New York Stock Exchange and led 1693 to 1109 on the NASDAQ. After Wednesday's post-FOMC announcement pullback, the financial sector and airline stocks were among Thursday's leader in a broad market advance. Look for entry opportunities in the direction of the trend according to your rules. Yesterday, the S&P 500 fell 0.81% in the wake of the 2 p.m. news of the Fed rate hike. Today, the index rallied to its late morning 0.84% intraday high, erasing yesterday's sell-off, but that level didn't hold. The index closed the session with a substantially trimmed 0.39%, which reclaimed half of the rate hike loss. The yield on the 10-year note closed at 2.60%, up 6 basis points from the previous close and the highest closing yield since September 18th of 2014. Home builders are giddy. While their stocks have been flat for several years, company officials are the most optimistic since the housing bubble years. In the past 30 years, they have been this positive on their industry only 3 times, and 2 of those have coincided with peaks in their stocks. Breadth can't keep up with its torrid pace from earlier this year. In the spring and summer, we discussed the extremely positive readings in the long-term McClellan Summation Index, which usually lead to good returns going forward. But now we're seeing stocks move to new highs and the Summation Index is lagging badly. It just started to peak and hasn't even receded, plus 500, a sign of divergence that has led to some weak returns over the next several weeks. The NASDAQ 100 took in the most money in 5 years. The QQQ fund expanded by $1.7 billion on Wednesday, its largest single-day gain in more than 5 years. That follows Tuesday's biggest of the year gains in the SPY and diamonds. When the major index funds have taken in so much money compared to their average over the past year, it has led to weakness in the broader market over the next couple of weeks, almost without exception. But that's running into the Santa rally. Positive seasonality is taken as a given this time of year, but between December options expiration, which is today, and the year-end Qs, rallied only 7 of 17 times and averaged a return of only 0.1%. The spiders rallied 56% of the time. Diamonds and IWM performed better, rallying 72 and 75% of the time, respectively. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:02 a.m. Mountain Time, and I am recording this in preparation for the market day of December the 16th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. At the time of this cut, all 4 of the U.S. broad-based indices were up just above scratch. Crude oil is up about 0.5%. Euro is up about 1/3%. Bonds are up just above scratch, and gold is up about 0.5%. And overseas action, looks like everybody's open. China is up just over scratch. Hong Kong down just below scratch. Japan's up about 0.2%. Germany's up about 1/3%, as is the United Kingdom. In terms of U.S. macroeconomic reports of note for today, we have building permits and housing starts, both before the market open. And then let's take a look at current volatility conditions. Short-term VIX has dropped a little bit compared to the prior session, 11.85, relatively low in the big picture of things. Skew is a bit elevated, up over the first threshold of warning level, coming in at a 129.44. IV percentiles for the S&P are 12, the Russell at 18, the NASDAQ at 12, and the Dow at 13. So all those are still exceptionally low. No standard deviations removed on any of the indices yesterday. So a quiet day after having quite a run, a pretty significant movement, especially if you're watching the NASDAQ and Russell. Russell's had some, 7 out of 10 sessions have had standard deviation size moves, with most of those going to the bull side in the last 2 rolling weeks. Let's go ahead and take a look at the charts. And on the S&P futures, you can see the recent action. Big parabolic short-term move, dark cloud cover, signaling a bit of a retracement. Some of that was retraced and taken back with yesterday's action. And some people would probably call this maybe a bullish harami. Certainly today's action is confirming that short-term bullish move. So ultimately, you put all this together, we have a short-term consolidation, and the expectation is that you'd have either a flag or a horizontal breakout and a continuation pattern to all this. Now, the question is how long does this consolidation last before the next leg, either direction? And there's some suggestions I read yesterday that suggest that this may not be over with yet. This may not be all the consolidation. So anyhow, bottom line, price action is what really matters, and that's what will tell us. We'll wait to see if we get a break of this pattern. Right now, it's just a kind of a short-term consolidation pattern and nothing really terribly more. And the Dow, we've also had this short-term consolidation pattern, very much like the S&P. You had the dark cloud cover, a little bit of a retracement back on that and follow through so far. Very, very similar patterns going between the two cousins, the S&P and the Dow at this point. Now on the other side, the other cousins, the NASDAQ and the Russell. Of course, with the NASDAQ, we finally got that breakout to join the other 3 indices up above the prior area of resistance that had been in place for so long. And we've had this kind of sideways, and you see these spinning tops thus far, though we had an intraday new high yesterday. Obviously pulled back from that. So lots of indecision as to where to go in the tech-centered market at this point. So we'll have to wait and see which direction it goes. Expectation is that it would continue to move to the bullish side, given the overall probabilities of the pattern. That being said, this spent so much time sideways, and though it was a very, very solid breakout candle, hasn't done anything at all since. So there's some danger that we could come back down into the range. Now remember that the Russell did come back into its range, but what was different about this is it spent just a nanosecond of time down there before a very big candle took you back out up to a new level and then continued. You also notice that you had this kind of retest of the bottom side of the channel, kind of a little bit of undercuts, but been running along the bottom of the channel right now. And remember, these areas of support and resistance are just that, areas. Don't get hung up on, micro amounts of undercuts. You've got the algorithms out there that are running stops of, small risk type traders who will often have stops just barely outside these edges, and then get run over by the computers who will scoop up all those contracts and so forth just to take it the other way once they accumulate that volume. And so these undercuts or overshoots by nominal amounts are not damaging to the overall technical picture. So right now, this is just respecting the area until we find a separation from that. In other markets, crude oil, of course, also had this overshoot, big overshoot of its range and then collapsed right back into the range, but then right now is trading back above that prior range and is trying to get back into this more bullish zone up above. So pretty sloppy, and we've said gold has been about as sloppy a chart as it can be for much of this year up until recently. Crude oil may be starting to take that mantle from the gold chart and just kind of give us this really, really sloppy patterns. In fact, let's take a look at gold. And gold, while it was super sloppy, while it was bullish, once it turned and broke down to the bearish side, it's been pretty reliable with a whole series of lower highs, and especially in the last 2 months, if you've tried to go bullish on gold for anything other than just very short periods of time, you've paid the price dearly as it steps back down hard the next level, and we continue to see that pattern. So be very wary of going long on gold. And of course, the dollar is part of that story. The dollar, with yesterday's action, set a new 14-year high. You have, with the negativity in gold, you have the long bond, and that also has been in a very sharp pattern to the downside. And just making sure we didn't have an island or anything like that down there. But anyhow, we've not yet seen any kind of a strong reversal pattern in this, and certainly have not seen a higher high on bonds in quite some time. So again, another market to not step in front of a strongly trending market. The volatility still remains in this very low, noise level, that 12 to 15, that's normal bull market volatility activity. So as long as it's in there 12 to 15 area, we don't get too worried about what the VIX chart is telling us. Let's go ahead and go to the daily report. And, still very, very bullish over here. Not a lot of changes from yesterday's session. Still market phase 4, price patterns near resistance or extension patterns. You have on the 3 market timing signals, confirmed uptrend from IBD, bullish. GMI index, a perfect 6 out of 6. Buy signal in place since 11:10, bullish. Stock charts decision point scoreboard, still very bullish on the short to intermediate term, but up against these mixed signals on the long term. The only thing that's going to fix that is a series of higher highs and higher lows, a stronger, more consistent pattern. We've started to see evidence that that may be coming to fruition, but not yet having achieved that. In terms of position sizing models, they're both still at 100%. And in terms of the intermediate term market postures, exceptionally strong bulls on all 4 markets and supported by exceptionally strong bullish sentiment lines. So any retracements are expected to be relatively short and mild in duration. Hedge warning status are at a level 0+, normal with some elevated conditions. Special opinions on option income, cover calls, and put selling, all basically positive, giving the opinion of new positions for novice traders are okay in the current market climate. A little bit of conservatism still in the cover call strategies, given just how deeply parabolic our recent moves have been. We've started to scrub a little bit of that off with the recent retracement, but it wasn't much of a retracement after a really large move. You might want to start considering a bit of a mix. Perhaps some of your positions that you initiate are 1-to-1 of out of the money strikes versus in the money, and some of them might be 2 out of the money strikes for every 1 out of the money, or in the money, I should say, strikes on your cover calls. Start putting a little bit more delta edge on some of those positions, not be quite as defensive, especially if we start to break and set a series of higher highs. I would expect that this would come off of its conservative stance and start to take a more positive delta setting. In terms of specific warning areas, some of them ebbed off from the prior session. Really only that stubborn high count coming from the NASDAQ on the distribution day count. We also have that mild warning on skew. In terms of trend-based, there's no warnings there. In terms of intermarket risk and aversion indicators, there actually was some improvement there. We now have 4 as risk on against only 1 signaling risk off. Sentiment relatively benign, though in the fear and greed index, this one's still up here in the extreme greed area. So kind of be aware of that. This means that we're on the lookout for reversal patterns. We did have reversal patterns set up in 3 of the 4 indices in recent sessions and got little teeny pullbacks with the FOMC decision, but nothing terribly extreme by any measure. And thus far, that's been it. So we continue to be a bit elevated. So we just continue to have a sensitivity towards reversal patterns. In terms of sector specific, pretty strong day yesterday. And you see here at the top, financials, materials, and energy, information tech, all doing pretty well. But you also have this mix of defensive, telecom, utilities, consumer staples are all up here as well with very solid breadth on the day. So it was a mixed day of risk on and defensive that were doing well. The 2 sectors that did not do well yesterday, consumer discretionary and real estate. So again, a mix of both kind of normally risk on and risk off defensive that were performing poorly yesterday. And in terms of market postures, you can see pretty much a sea of green. Industrials, materials, retail showing some minor weakness. Nothing compared to what we had seen in prior sessions when some of this was more polarized. We've started to see pretty much everything moving up now, though some are stronger than others, and certainly financials. This doesn't distinguish between up and up versus up and up and up. Well, financials certainly, if you look at relative performance, are much stronger than some of those other sectors that are also flagging 3 ups. And you can see that better when you take a look at the time frame percent change analysis, 1, 5, 1 month, 3 month, etc. And you look at the 3-month performance on financials and even the performance since the election period. And then for that matter, financials, telecom, energy, information technology, all up. Materials also all up more than 5% in the last month. So this is probably the better place to kind of distinguish not just market posture, but just how relatively strong some of these areas have been. Okay, that should be about enough for today. Let's go ahead and wrap this thing up. And if you see something of interest, just hit the pause button, gather your information, go to the hyperlink to get additional details. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll be back here on Monday for our next Falcon Global Market preview. In the meantime, manage that risk and go out there and learn something every single trading day about your chosen field. Good trading.